All right, so Elizabeth just mentioned that you've officially launched WGames here at Casual Connect. And fortunately, I had a lot of early heads up on this announcement because you hired someone who, like myself, has been designing slot games for over 20 years and has actually been a rival of mine for literally 47 years. I'm talking about my younger brother, Ben Gomez, and ever since that guy was born, he's just been trying to show me up. So congratulations on that. So as we begin this chat, I think one of the things that's interesting is it's kind of an oxymoron. We're talking about growing in a maturing market. And when I think of growth, I think, oh, the market's stable. It's not really, or when I think of maturing, I think it's stable. Tell me about your thoughts on the market. I mean, is there funding still out there? Is this a place where there's an opportunity?
Well, okay. So is there funding out there? I think the same principle goes for any business. There's always money for a good deal. Well, I think that's a good way to start this session. As it relates to growth, yes, we clearly know that the market is growing. As per Eilers, we've had a 17% growth year over year as far as the market value is concerned. However, there seems to be a gap, and a bigger gap between those that are, let's say, the top 15. I think there's been many talks of it, that the kind of percentage of the market they command, I think it's roughly around 85 or 86%, and the rest of the gang that's trying to break in. Whether or not there'll be growth, yes, there will be growth. How that growth is achieved, especially for newcomers, I think we're working our way at a stage in our industry which we're dealing with a mature market that you need to have predominantly two things in place. One is a niche market or a particular angle that you establish your business, and the second is execution. No longer or gone are the days where you can kind of just have a small little indie development team of 2 to 3 guys and kind of put it up on the internet and see what happens. Now I think there's a lot more sophistication involved, and that speaks to this infrastructure and the structure and the approach in executing your plan. But to say that, yes, absolutely.
Well, a lot of people have seen you in talks, and it's been a very formal presentations. This is kind of an informal chat, and over the years, Daniel and I have had these informal chats. In fact, this interview is one of the easiest things I've ever done because oftentimes at Casual Connect parties or after parties or hotel lobbies the next morning, we're having these discussions. So what I did is I took the opportunity, instead of us having the same questions we always have at the party and walking around the show floor, I gathered a bunch of questions from people to say, what about this discussion would you find interesting? And it really came towards the people who haven't had an experience in raising funding before. They had a lot of questions. So I'm going to go through some of the questions that were given to me, and one of the questions just was basically what we just said: is there money out there? One of the other questions also was, aside from the funding, was acquisition opportunities. I mean, we've looked at things like Playtika being bought for $4.4 billion in cash, basically, Double Down being acquired a second time. Aside from, is there funding out there, is there still going to be acquisition opportunities? And if so, are there the large types of acquisitions we've seen in the past, or are they going to be smaller, niche types of things?
Well, it's interesting because it seemed like just yesterday where the company reached about a 20 million revenue mark, they tended to get picked up real quick. I think that bar has been gradually increasing, probably due to the fact that some of the players from an investment point of view, from an investment side, more sophisticated, bigger margins, bigger money is entering the market. We all know, obviously, the $4.4 billion acquisition, and Giant wasn't the only bidder. So there's definitely, in my view, appetite for a good, solid company. As long as all the fundamentals are there, there is a ability for the companies to demonstrate long-term growth. I think the valuations are there, and I think that the companies can find the potential buyers. On the smaller side of things, obviously the smaller the value or the smaller the investment, you're looking at a broader range of potential buyers. It's not as significantly, or it's not as difficult to find the right acquirer. There's very many different approaches or different types of companies that are in demand, whether it be starting from a basic, putting the EBITDA on your balance sheet, or whether it's a strategic acquisition where an innovative group or an innovation by all accounts is acquired, is all works to the point that both sides, in my view, are attainable, and there's definitely a big amount of appetite. Just as we speak in this current Casual Connect, I've already run into a couple of different potential acquirers looking for the right company, and they've got the money, they're willing to pay, but just got to find the right deal.
All right, another popular question, in fact, many people ask me about it because there's a lot of young indie developers. When I got into the business, I was pretty naive, and I just thought, we built a great product, if you build it, they will come. And my thoughts towards funding was, it didn't matter where I got my funding, whether it was friends and family, whether it was an angel investor or a VC, all that mattered was I got the money. And I guess, I learned that the source of where you get your money from is kind of important. Can you talk a little bit towards that?
So it is important, obviously. I think generally speaking, as it relates to an investment group, there's probably 3 points that as a company owner, as an entrepreneur, you want to look at. And you have to be true to yourself, and you have to be very pragmatic about it. And the first thing is, and most other things kind of relate back to the point is, more often than not, as entrepreneurs, we put ourselves in a position that we do view money as money. And if you ask anybody from the financial side of things, they always say, if you're offered money, take it. And I'll probably end up giving the same advice as well. But that said, I think there ought to be a little bit more thought given to follow-on investment. More often than not, good quality companies are orphaned by virtue of the fact that their initial investors are either tapped out or they didn't have the ability or the investment strategy to back the business as it grows. So that's the first one. As it relates to the other fundamentals of it, bottom line is you need to find a group that believes in your vision, has confidence in your vision and ability to execute. That is usually a more simple approach, is to identify where your milestones are, identify everything up front. Don't try and fool yourself or fool them into something that's unrealistic, because your success and your support that you get from your investors are very much going to be based on your performance as you grow. As you're talking about family or angel investors or things of that nature, the last point is you have to understand and do a little bit of due diligence on the investment group. There are practical matters that can impede on your investment from the side of a fund or anybody else. There's certain limitations as far as what their criteria is, what their mandate is, whether or not they can hold a certain percentage in your company, which in follow-up rounds may impede on their ability to participate. And whether it's an angel investor, it typically comes back down to the same thing. Have a strategy for your follow-on investment. Make sure that they're supportive of your vision, and they back that in terms of evaluation that you're going to grow. Most investors are sophisticated. Someone's going to put up their hard-earned money, tax-paid money, to back a business, and they establish a valuation with you. So as long as you meet your projections, as long as you're true and you actually build a business and your trajectory is on the right path, you typically shouldn't have an issue increasing that valuation for both yourself and your eventual investors.
So I noticed when I was talking to people, especially some of these the younger teams that are getting put together, do you think that people pass up legitimate financing opportunities because they've got this vision and they think they have the next great thing, so they have unrealistic valuation expectations, or is the vice versa true? I guess the question is, when people think they're made of gold, are they holding out too much, or should they grab funding when they have the opportunity to?
So I've seen a couple of really successful companies. They did think they were made out of gold, and their expectations were way out of the realm of reality. And I think some of you who are in that type of climate will know of those companies because they still haven't been acquired. But as far as establishing valuation, whether it's too high or too low, I'm a big believer that that's a subjective thing, and at the end of the day, your valuation comes down to one point. Does the investor, or is the investor willing to pay you that amount for it? And that's your valuation. So yes, there are a lot of metrics. There's different ways that analysts will look at things. Some companies that are already on the go in terms of revenue and growth trajectory, they're valued, but whether it's on their EBITDA and their potential. But from a seed investor side, from a seed point of view where you're still not out there, you still have a lot to prove, it's about confidence. It really comes down to confidence and whether or not the person who's going to write that check has the confidence in your ability and they believe they're going to get a return on their investment. And so as long as you have that, I think that's your valuation. Now, subsequent rounds, whether it's to a downward trend or not, honestly, typically it means there's a problem with the execution. And when somebody sees a flat business or when there's holes and they can poke holes at it, I think that's where you're going to come to a challenge. Where the industry is today, as far as valuation or as far as investment is concerned, I think from the risk assessment and the reward, they're both going up. It's more difficult to enter the market successfully, and at the same time, we know that those who are able to break through into the top 15, the rewards are remarkably high. So from an investor's point of view, they ought to take those factors into consideration. Yes, it's difficult to get into the market. Yes, there is a great deal of risk associated with investing into the sector, given the very competitive nature of it. However, the rewards are tremendous, and we've seen that time and time again.
One of the things that I've discussed with a lot of people is you have this vision, you're building your product, and you want to maintain control. And some people are like, well, this guy wants to invest, but he wants some board seats, or he wants to install some management in my company, and I don't want to give up control. What deal can I put in place so I don't give up control? And I think you and I have talked about this. Sometimes that's not the best thing if it's outside your core competency. If you're a tech guy, focus on your tech. But can you kind of expand on that?
Well, listen, capitalism is a great thing, and it's going to play its role whether we like it or not, and however it is. I recall an interview with George Lucas, and many people asked him after the acquisition by Disney of Lucasfilms, why are you stepping aside? And I think one of the main points he said was he felt that once he lost control, he couldn't implement his vision, and he didn't feel that was his baby anymore. And I think that's true to a large degree as it relates to any business. Whether you're an entrepreneur with a lot of passion and desire and you garner the confidence of your investors is a critical thing in your execution. If you get to a point that your investors that have qualms or issues with you, there's usually a good reason for it. And for someone to think, okay, how do I not want to lose control? It really comes down to the structure of the business and how you structure that from day one. And going back to the first point of being able to look down the track and say, okay, this is the valuation I'm coming at. This is the cap table. This is what I'm going to be in control of. What's going to happen? What are the scenarios in the next round, the round after that? What are we going to achieve? Who are we going to attract? And what type of investor are they? There are two kinds of different investors typically. There's the passive investor that really needs to just believe you, look in you in the eye at the end of the day and believe in you, believe in your vision, have confidence in you. Those are the easy ones. And then there's investors that are active investors. They would like to participate, have a seat on the board, be able to do it. That could be a big plus and a big opportunity for any individual because they can open a lot of doors, they can bring a lot of wisdom, insight, and color to the business that otherwise you wouldn't have. But that said, you want to make sure if you're going to end up, your pitch is social casino, you want to make sure that in 2 years from now you're not doing cherry picking app. So make sure that you see eye to eye and you've got the right group involved from the beginning.
So, that kind of just basically means you have to look at your investor as a partner and make sure that you kind of share a common vision. And I think in the social casino space, people are very focused on the space, and people have pivoted into this space. Very few companies pivot out of social casino. But there is one thing that I noticed that companies that don't have an active investor or somebody that has a strong management, or they haven't brought in a CEO with experience, they bring in some money, maybe it's a small initial round, and then they start to have some success. And they think, wait, maybe we don't need any more money. Let's just see if we can keep our revenue coming in. And then they actually get dangerously low on cash reserves. And you and I both are of the same mind of don't run out of money. So do you think that if you don't have that kind of active investor that you do run those risks of doing things like being dangerously low in cash? And
you know what? Thank you, Al, for asking me the easy questions. I can slide out of this one. So look, first of all, I think back to the first thing I said, I really believe that good deals, good companies will always have an investor. You'll always find money. That's given. As it relates to managing or worrying about running out of cash, or if you're a company that's successful, look, that's what it boils down to. And I think it's important. Management of investors is important. Having visibility out there is important. But bottom line is, if you've got a good product and a good solid team, focus on your business. Believe me, there's a lot of people that are watching. There's ample amount of money out there for great deals. And at the right time, in quick order, you can find that.
All right, well, I think it's about time for some audience questions. So if there's anyone who has some questions.
Guys, I enjoyed the interview. Thank you for having it. So I have a startup, and I'm going to be looking at some funding. So I actually had a few questions, but I'll start with the first one. So I've heard about this supposed black hole of investment between $1 million and $5 million. From your experience, does that exist today, and is that the right threshold?
Black hole of 1 to 5 million. So, and 1 to 5 million being the amount or the valuation?
The amount.
The amount. Okay. So what we're seeing a lot of is more and more investors are treating companies like another number. They either have an approach from a passive investor base where they'll they'll put together a pool. Their theory is to put a little bit of money into a number of different companies, and if it takes off, it takes off. Where that becomes an issue is that more often than not, those very investors, and in many cases we use these guys, we put them on our deck, we're so proud of it. The reality is that they're not going to be there for you on the second or third round. And while you're banking on this and you're excited that they have a lot of money, the reality is their allocation to your business is limited. So going back to them again and say, okay, I've got some growth, and in most cases, I've got some troubles, and we need certain adjustment, that becomes an issue. And so you need to be very careful in crafting that. It's not a bad thing to take that money. And you still have to have a strategy as to how involved they're going to be in your business, whether or not there will be conflict of interest, whether or not there'll be a predicament to your subsequent rounds as it relates to any new investors. And that's bottom line to it. That's what you need to do. Now, how you approach it, what your business plan is, and how it grows, that's a judgment that you need to do and how well you execute on your plan.
With regards to, so I have an MVP, and I'm a startup, so I'm pre-launch, pre-revenue. With regards to the valuation, what's the most important metric that a potential VC or angel investor will look at my company?
So the second part of your point was whether an angel investor or a VC should look at and what they're going to look at. And more often than not, unfortunately, pre-revenue companies, you need to be able to sell the potential. That's where your valuation is. It's not in any type of result that you've been able to show. A company with 2 to 3 years of track record, it's easy. We all know how to measure that. You've got passion, you've got an idea that you believe in it, and you need to be able to sell that. Now, looking at the potential investor, whether it's an angel investor or a VC, you need to try and understand what metrics they look at. What is their way of measuring whether this is a good deal or not? Unfortunately for us in the social casino business, it's still a very niche market. It's still foreign to many, many investors. And their tools to measure whether it's a good, viable product or not, other than relationships, is to look at hard facts, which are often absent in a startup or an MVP. What I would do if I were you, I would try and articulate a pro forma that can substantiate growth based on facts, based on the reality of the market. We need to do that. That coupled with the pedigree and the credentials of the person that's involved, that together can be a very good selling point. And what I found is that at the end of the day, as it relates to MVPs or to any pre-revenue company, it goes back to the old thing. You need to be able to gain the confidence of that person. From a VC perspective, they're typically a lot tougher because they're managing someone else's money. They can easily say no to you, move on to the next one. Whereas an angel investor, someone that's earned the money themselves, typically we might think that's a more difficult thing, but they're more, their appetite for risk is typically a little bit higher if they believe in you. I think that's where the big selling job comes. And more often than not, you see that the investment is made on the horse, not necessarily the carriage, if that makes any sense.
Last question. So I think you mentioned the pro forma. What kind of cash out horizon should I expect?
Can you repeat the question?
With regards to the pro forma, what sort of cash out horizon should I expect investors are looking for when they evaluate my company?
So it varies. So certain funds have a typical investment mandate for a horizon set of, let's say, 3 years. Typically, they come in with an expectation that they're going to be able to take money off the table within that 3 years. And from what I've seen before in other companies and people that have kind of reached that 3 years and weren't necessarily ready for an exit, it becomes a challenge because they've got their own mandate and their own portfolio to adhere to. So you will be under pressure. And more often than not, you hear stories where people were forced into a sale or they were forced to exit because they needed to take money out. So you ought to look at that as it relates to VCs. As far as angel investors or anybody else goes, typically they're there for the ride. I guess the ultimate challenge when you're approaching an investor or an angel investor is make sure that the investment they make into you is not going to top them out. That's not their biggest investment, and they're not going to be breathing down your neck every day. Because typically, traditionally, that's the cost for someone to panic, or whether it's at the first sign of success or first sign of failure to try and push their weight on you to make some sort of an exit.
Okay, I think that's it. Thank you so much,
Thank you
gentlemen.
so much.
Really appreciate